Most people believe banks lend out money that already exists. You deposit your paycheck, the bank stores it, then someone else borrows it. Simple. Except that's not actually what happens. Because when banks issue a loan, they usually create brand new money, money that didn't exist a moment earlier. Which leads to a strange realization. Most of the money in the modern economy didn't come from a printing press, and it didn't come from government vaults. It came from bank loans. Think about how people imagine banking works. You deposit your paycheck into your bank account, the bank keeps that money safe. Then when someone wants a loan, maybe for a house, a car, or a business, the bank lends out some of the deposits it already has. In this story, banks are just middlemen. They move money from savers to borrowers. Money goes in, money goes out. It sounds logical. But modern banking works very differently. Here's the first surprising truth. When a bank approves a loan, it usually doesn't take money from someone else's savings. Instead, it creates new money, right at that moment, with a few keystrokes. Imagine you walk into a bank and apply for a mortgage. You want to borrow $300,000 to buy a house. The bank reviews your income, your credit history, your job stability. After some checks, the bank approves the loan. Now here's the key moment. The bank doesn't search through its vault looking for $300,000. Instead, it opens your account and types the number into existence. Suddenly, your balance shows $300,000. Money that didn't exist a minute ago is now sitting in your account. Brand new money has just entered the economy. At the exact same time, the bank records something else. On its balance sheet, your mortgage becomes an asset. You now owe the bank $300,000. So two things appear at once. You gain a deposit, the bank gains a loan. Both sides expand together. The loan creates the deposit, not the other way around. This idea feels backwards because we're used to thinking of money as something physical, coins, stacks of bills, gold bars in vaults. But in the modern economy, physical cash is only a tiny slice of the total money supply. Most money exists only as numbers inside bank accounts, digital entries on ledgers. And banks create many of those entries when they issue loans. At this point, a natural question appears. If banks can create money when they lend, what stops them from creating unlimited money? Why not approve loans for everyone? Why not create billions overnight? Three major forces limit how much money banks can create. The first is risk. Every loan carries the possibility that the borrower might not repay it. If too many loans fail, the bank loses money. Enough bad loans can even collapse the institution. So banks are careful about who they lend to. Income, credit history, collateral, all of it matters. Because when a loan fails, the asset the bank created disappears. The second constraint is capital. Banks are required to hold a certain amount of their own money relative to the loans they issue. This capital acts like a safety cushion. If borrowers default, the bank absorbs those losses using its own funds. Without enough capital, a bank simply can't expand lending very far. So even though banks create money through lending, they still need financial buffers. The third constraint involves the banking network itself. Because banks don't operate in isolation, they constantly send money to each other. Imagine you take that $300,000 mortgage deposit and pay the home seller, but the seller uses a different bank. Now your bank has to transfer money to the seller's bank. Behind the scenes, something called reserves are used to settle that payment. Reserves are a special form of money that banks hold at the central bank. When money moves between banks, reserves move behind the scenes to settle the transaction. If too much money leaves a bank, reserves flow out with it. And if reserves run too low, the bank has to borrow them from other banks or from the central bank. So while banks can create deposits through lending, they still have to operate inside a larger financial system, and that system imposes limits. But here's the key insight. Banks are not simply lending existing money, they're expanding the total money supply. Every new loan creates new money. Now imagine this happening across an entire country. Millions of mortgages, millions of business loans, millions of credit lines for equipment, inventory, and payroll. Each one creates new deposits, new money entering the economy. The banking system is constantly expanding and contracting the money supply through lending. This is why credit cycles are so powerful.
When banks feel confident about the future, lending grows quickly. More loans, more deposits, more money circulating. Businesses expand, consumers spend more, asset prices rise, the economy grows. But when banks become cautious, the process reverses. Lending slows, fewer loans are issued, less new money enters the system. And sometimes the process runs in reverse, because when loans are paid back, the money created by those loans disappears. The deposit shrinks, the bank's asset disappears. Money is effectively destroyed. So the money supply is constantly changing, expanding when loans grow, contracting when loans shrink. It's almost like breathing. Loans inhale money into the economy, repayments exhale it back out. Now think about what this means for everyday life. Housing prices, stock markets, business investment, consumer spending. All of them are heavily influenced by how much credit banks are creating. When credit flows freely, economic activity tends to surge. When credit tightens, everything slows down. Even government policy revolves around this system. Central banks try to influence lending by adjusting interest rates. Lower rates make borrowing cheaper. More people take loans. Money creation accelerates. Higher rates make loans more expensive. Borrowing slows. Money creation cools off. But here's another subtle twist. Central banks don't directly create most of the money either. They influence the system. They guide it. But commercial banks still generate most of the money through lending decisions. Which leads to a surprising conclusion. Banks don't simply move money around. They manufacture it. Not with printing presses, but with balance sheets. Once you understand this, a lot of things about the economy start to make sense. Why housing booms happen. Why debt levels tend to rise over time. Why financial crises spread so quickly. Because the entire system runs on expanding and contracting credit. It also explains why banks are treated differently from most businesses. A restaurant can't create money. A clothing store can't create money. But a bank expands the money supply every time it approves a loan. That power makes banks central to the modern economy, and it also means instability inside banks can ripple across the entire financial system. Now, step back and think about the money you interact with every day. Your paycheck, your savings, your mortgage, your credit card balance, your business loans. A huge portion of that money began life the same way, as a bank loan, typed into existence during a lending decision. Money isn't just something that circulates, it's something that gets created, constantly, quietly, inside the banking system. And once you see it that way, the economy starts to look very different. Less like a giant pile of money being moved around, and more like a living system, one where money appears and disappears depending on how much people are willing to borrow and how willing banks are to lend. Which leads to one final realization. The money sitting in your bank account might feel permanent, solid, like it's been there all along, but much of the world's money only exists because someone, somewhere is still paying off a loan. And if those loans were suddenly paid back tomorrow, trillions of dollars would quietly vanish from existence.